in the chat saying smoke that thumbs up like Cheech and Chong and the and show the algo what's up. Well, thank you so much, All Nighter, for being here. We got quite a few people who have already joined in. Got dishes with the smiley face. Thank you so much for being here, mamas. 9 people watching, 9 thumbs up, man. I can't tell you to go hit that like button if you're already hitting the like button when you come into the live stream. So thank you so much for doing that and being supportive of the Uneducated Economist. Today we're going to be talking about how the sticky inflation is a burden to the Federal Reserve. And now, of course, if you've been following my channel for any length of time, this is not what you would believe, not even for a second. We look at the Federal Reserve and their monetary policy stated from their own words in a much different fashion than that of the mainstream media or pretty much anybody else who's like actually paying attention to the mainstream media as opposed to paying attention to what's really being stated by the Federal Reserve. They do not see it. Even when it's thrown right into their face, they will not see the monetary policy correctly from the Federal Reserve. Mainly when we think about the inflation and the inflation scenario that we are now facing today. The report that came out to Congress, this is a report that was dated February 7th of 2025. We have just talked about this report. I'm going to cover it again just real quickly here because in this report is the statement on long-run goals and monetary policy strategies. Now, this was adopted and effective of January 24th of 2012 as reaffirmed effective January 30th of 2024, so just a year ago. Now, in this statement, again, this is a report that went to Congress just the other day, right, that talks about their monetary policy and what it is that they are looking to consider for monetary policy, and it has these words directly. The inflation rate over the long run is primarily determined by monetary policy, and hence the committee has the ability to specify a long-run goal for the inflation. For inflation. The committee reaffirms its judgment that inflation at a rate of 2% as measured by an annual change in the price index for personal consumption expenditures is most consistent over the long run with the Federal Reserve statutory mandate. The committee judges that long-term inflation expectations that are well anchored at 2% foster price stability and moderate long-term interest rates, and hence the committee's ability to promote maximum employment in the face of significant economic disturbances. Okay, here it comes. In order to anchor long-term inflation expectations at this level, the committee seeks to achieve inflation that averages 2% over time, and therefore judges following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. This is again stated directly to Congress just a couple of days ago, coming from the Federal Reserve. They are not going for a 2% target. I don't know how many times I have tried to say that on this channel. They are not going for a 2% target. This proves it straight up. They are not going for a 2% target. They are going to achieve inflation moderately above 2% for some time. Now, again, when I look at the mainstream media, think about the article that I left down in the description talking about the Federal Reserve burdened with the sticky inflation, can't get it down, oh, this bummer inflation. And I'm thinking to myself, this is exactly what they said that they were going to do. 5 years ago, they said that they were going to do this, and they just told Congress again that they are doing this. This is not a mistake. This is not them struggling to try and figure out how to get inflation into the position in which that they want it. They are exactly where they want to be. This is the sweet spot. It's sticky sweet to them. Everybody else says, man, it's sticky inflation. Can't quite get it there. And the Federal Reserve's like, yeah, I can't quite get it there. I wonder why. Because we're going for this exact position. We're not trying to get anywhere else but where we are today, right here. All right. A lot of times people think, okay, well, the Federal Reserve has control over inflation. They don't. They have control over inflation expectation. And I can prove how they control inflation expectation, not by the interest rate move. No, the interest rate move doesn't control inflation. You know what controls inflation? The delivery of the information. And I got proof of it right here with the makeup strategy. Now, I left a link down in the description for you guys to the makeup strategy. Let me see, where is it at here? What did I put it in a different file? Where is it here? Makeup strategy, right there. This is what it has to say in the makeup strategy. Okay, now the makeup strategy is to make up for the fact that the Federal Reserve failed to achieve the inflationary scenario that they were looking for over the previous 10 years. They could not get it to the 2% target. When they did, it was there for a very short time, and for the most part, they ran under 2% the entire time, even after quantitative easing 1, 2, 3, and 4. Now, of course, we can look at it differently. A lot of people will be like, oh no, bro, man, inflation's run much harder than that. Okay, I would agree with that, but that's not what the Federal Reserve is looking at, and we're not looking at what it is that we think there should be. We're looking at it the way it is and what the Federal Reserve is stating. Now, again, we can say, hey, the Federal Reserve screwed up, they don't know what they're doing, all this other stuff, or we can take it into consideration that they had a devious plan set into motion a very long time ago. And I'm showing the plan right now. See, people say all the time, how do you end the Federal Reserve? You do it by this. You do it by understanding their strategy so that they can no longer use it. Think about this, okay? The Federal Open Market Committee may not be able to provide sufficient support of the economic activity or prevent persistent undershooting of its inflation objective when the effective lower bound of the Fed funds rate is binding for a protracted period. Okay, so what they are saying is that when the Fed funds rate hit zero, they ran out of monetary policy, and if there was a downturn in economic activity, they wouldn't be able to stimulate the economy with the dropping of the Fed funds rate because of what they refer to as the effective lower bound. That's zero. Fed funds rate hits zero, that's the effective lower bound. As discussed in Aries and others 2020, this paper that they were referring to, subsequently referred to as the companion paper, better economic outcomes might be achieved by alternative monetary policy strategies that aim to offset, at least in part, past misses of inflation from its objective. You see what they're saying? They were going to make up for the fact that they failed to achieve the 2% target. Straight up. Right? Alternative monetary policy strategies aim to offset, at least in part, past misses from the inflation objective. These strategies are broadly referred to as, quote, make-up strategies. In this paper, we analyze the robustness of such strategies with particular focus on ways the public might form expectations of future economic developments. Now, here we go. This is the major psyops part of it. Guys, you want to know how the inflationary expectation is created? You want to know if the interest rate cut is going to create an inflationary or disinflationary outcome? Here it comes. This is how the Federal Reserve does it. I'm going to explain it right now to you. Make-up strategies work best when the public understands, believes, and reacts to policymakers' commitment to offset the inflation from the 2% objective in the future. Here we go. In particular, make-up strategies are most powerful when the policymaker can influence the public's inflation expectations. In doing so, policymakers face dynamic tensions. They must maintain long-run inflation expectations around 2% objective, while at the same time moving shorter-run inflation expectations in response to the new strategy. All right? So you understand that they have to do this in this fashion. They have to deliver the information in a particular way. When they deliver that information in a particular way, they can get the outcome that they are looking for. All right, hold on one second here. Oops. Let me bring it up. My little computer here likes to shut down on me all the time. Oops. Okay. Inflation expectations, here we go. Inflation expectations are more difficult to assess because they depend on the public's interpretation of the guidance. They depend on the public's interpretation of the guidance. How is the public receiving this information? An unexpected loosening could lower inflation expectations. An unexpected loosening could lower inflation expectations if the public interpreted this action as the Federal Reserve predicting a weak economic future, a weak economy in the future. So again, I'm going to say that one more time because this is really important. This is how they play the game. See, the action doesn't change. Think about this. The Federal Reserve is going to cut. Okay, let's set that aside for just a second because the interest rate adjustment isn't the big deal. How they deliver the information is a big deal, and they're telling you right here that if you get the information, if you receive the information in a particular way, it'll create an inflationary expectation. If you receive it in a different way, it will create a disinflationary expectation. The same action takes place. An unexpected loosening could lower inflation expectations if the public interpreted this action as the Federal Reserve predicting a weak economy in the future. If the public instead saw the change as simply reflecting a more accommodative policy stance, inflation expectations would be expected to rise. Same action, different outcome based on the delivery of the information. Did you see what happens here? This is how they play the game. Nobody sees it this way. You and I, the 130 people, the few people who follow the credible threat theory on a regular basis, we see it. Nobody else sees it. This is information unlike anybody else is getting because they do not see it this way. They think that the Federal Reserve can't get it to 2%. They don't realize that the Federal Reserve blatantly says it straight up to Congress, we are going for moderately above 2% for some time, and we don't even have a mathematical formula for figuring it out. Since most people don't see it that way, they already got the Federal Reserve strategy wrong. Now, when they talk about the Fed funds rate and they talk about the cutting of interest rate and what kind of impact that has on the economy, it doesn't matter what the rate cut is. It's the delivery of the information. They talk about it right here, that if the unexpected loosening could lower inflation expectations if the public interpreted the action as the Federal Reserve predicting a weak economy in the future. Well, think about it. A half a rate point cut that we received, 6 months ago or whatever it was, and how dramatic people took that information and said, this is the Federal Reserve going into an emergency rate cut, bigger than anything ever happened. The economy must be weak. Labor market must be shit. All this other stuff is being pushed out there within the mainstream media, lowered the inflation expectation. All right? The next two rate cuts come out, very benign. We're casually doing this. This is just part of the effect. We're trying to casually get ourselves to neutral. This isn't an emergency. We don't even really know if we should be cutting right now. We're just kind of doing it. Inflation expectation begins to rise. You see how they work this? You see how they use the people against it? They use the information against the people. They use it to push out a particular belief so that they could get the outcome that they are looking for. It's all about the meaning that you're giving the information because the rate cut itself happened regardless. But how we received the information either had an inflationary or a disinflationary expectation to it. Again, I'm going to read it one more time just so it's clear. And again, I left this down in the description. You guys can go and read this all for yourself. This is the information that I have pulled out. The unexpected loosening could lower inflation expectations. Think about that half a rate point cut. It could lower inflation expectations if the public interpreted this action as the Federal Reserve predicting a weak economy. So if the Federal Reserve is predicting a weak economy because they lowered inflation or lowered the interest rates as dramatically as it did, it would have a lowering of inflation expectations if the public instead saw the change simply reflecting a more accommodative policy stance, saying, hey man, we're doing this for benign purposes. We're going to, ease up on policy here a little bit, not for a weakening of economy. This in turn would have an elevated inflation expectation. Same thing, same move delivered differently, and that's all it took. Nobody sees it like that, right? Nobody sees it. They'll go and make up all kinds of other stuff. And what I think is pretty interesting is even right now, considering that the Federal Reserve went neutral, right, with their policy stance on where they are, not neutral like the Fed funds rate isn't neutral. They went neutral with their communications. We don't know what we're going to do. We may need to raise, may need to cut. Right now we're holding steady just to see what kind of happens. Now the inflation expectation goes back onto the administration and all the push for tariffs. Think about the inflation expectation that comes from this. They haven't done anything yet. They threatened all kinds of stuff. sovereign wealth funds, 25% tariffs on Mexico and Canada, all these possible tariffs coming to steal whatever, right? All these credible threats that are coming elevates the inflation expectation. Federal Reserve doesn't have to do anything at all. Now, somebody might ask me, why in the world would they even do all that? It's so that they could get the neutral interest rate to the Fed funds. They're trying to elevate the neutral interest rate. Why? Because of the very first thing that I had talked about within this, which is when the Federal Reserve is at the effective lower bound. When the Fed funds rate is close to zero, it can't stimulate the economy because it's so close to zero. Now, if they elevate the Fed funds rate up, there's something called the neutral interest rate, which is neither accommodating nor restricting the economy, and that neutral interest rate was really low as well. The higher the inflation expectation, the more elevated the interest rates are, the continuous impact to the economy that takes place from this elevated inflation expectation and elevated prices and elevated interest rates is the neutral interest rate starts to rise. That's what the Federal Reserve is wanting. It's what they're looking for. It's what they're hoping for. And they're getting it. It's like it's working so well for them. Nobody knows it because they don't see it this way. The information that they are getting delivered says, oh, the Federal Reserve has got sticky inflation. They don't know what to do about it. They're trying so hard. But yet, that's the information that they're getting. That's the way they're receiving it. The reality of the situation is much different. The Federal Reserve was looking, wanting, hoping, dreaming, praying, and God delivered a higher inflation expectation, which raises the neutral interest rate, which is exactly what they were hoping for. All this stuff is working out the way that they wanted it. It's all part of this credible threat theory that I have been trying to push and show everybody. And again, like, for those of you who need a quick rundown of the credible threat theory, it's their words that they use in order to guide the markets. The expectations of what is going to come is what is being used against the people. It's not the reality of the situation, right? People want to take it in and consider it reality, even though it's not there yet. Okay? It's the possibilities. There's a great example of this. Let me bring it up to you. Let me show you here. See, it comes down from a gold machine. Let me just tell you about the gold machine. Ben Bernanke had this speech back in the early 2000s talking about deflation and how to prevent it from ever occurring here in the United States. He talked about this hypothetical gold machine and that if there is a story that comes out that this guy has built a gold machine or has the ability to have this gold machine to produce as much gold at will with very little cost or energy, the moment that information gets out to the public, it would cause the price of gold to plummet immediately. Right? So this little scenario that he had talked about, it's a hypothetical situation, but the reality, if you could scientifically prove that this guy could do it, it would start causing a market reaction to take place, and it totally works. Here's an example of it taking place back in May 21st of 2020. This is a speech called U.S. Economic Outlook and Monetary Policy given by Richard Clarida. Right? And now this is what it has to say in this speech. Now I'm going to go back up a little ways so that we can get a better understanding of what's going on. This is right when COVID's kicking in. Unusual and exigent circumstances are now running through the economy. Federal Reserve is stepping up, government stepping up. There are all kinds of warlike effort taking place. So this is what's going on right now. Since March 17th, the Federal Reserve Board has announced the establishment of no fewer than 9 new facilities to support the flow of credit to households and businesses. Very important to understand. This is when they were ramping up these facilities to support households and businesses. This is like the payroll protection program. This was like the I don't know, they had a bunch of different ones. The one we're going to talk about is the corporate debt lending facility. But there was all these different facilities that were set up to backstop every corner of the financial market. These programs are authorized under emergency lending powers granted to the Federal Reserve, Section 13.3 of the Federal Reserve Act, and are available only in unusual and exigent circumstances. These things could not exist otherwise. In fact, people probably don't even know that they exist, except for the idea that if you understood the Federal Reserve and the emergency lending powers that they might have, most people don't consider this as part of their strategy or market, understanding of how the Federal Reserve operates. So the unusual and exigent circumstances all of a sudden gave powers to the Federal Reserve that they would never have had before. Like, they would not be able to do this in any other situation, but because of the pandemic, they were able to use these powers. Says, I think you will agree today, this is back to Richard's speech, I think you'll agree today that we face circumstances that are both exigent and unusual. These facilities are supported with money invested by the Department of Treasury, drawing on appropriations of more than $450 billion, authorized by Congress in the CARES Act, the Coronavirus Aid Relief Economic Security Act, for specific purposes of investing in Fed programs to sustain the flow of credit to households, firms, and communities during the coronavirus pandemic. So this was set up to basically hey man, there is issues taking place. We are going to be able to provide a flow of credit to the economy no matter what's going on, because this is an unusual and exigent circumstances, and we've put $450 billion towards this effort. Now, with these facilities, here back to Richard's speech, with these facilities, we are providing a bridge by stepping in and supporting lending throughout the economy until the recovery takes hold, right? So they're going to be loaning this money because it's unusual and it's exigent circumstances into particular areas that normally it wouldn't go to, because, right, this is not legally allowed. But it's unusual and exigent circumstances. These programs are designed to offer a backstop source of funding to private sector, right? Funding to the private. And just the announcements that these backstop facilities would soon be launched appears to have bolstered confidence in the capital markets, allowing many companies to finance themselves privately even before the facilities were up and running. The credible threat that these things existed or going to exist, funded with hundreds of billions of dollars, with the announcement through the mainstream media and even guys on YouTube like me screaming that the Federal Reserve was going to be picking the winners and losers, and that information within itself being pushed out there was enough to get the people, the market, to front run the Federal Reserve, start buying into corporate debt, funded these corporations with an incredible amount of money. While they gorged on that incredible cheap debt, the facilities hadn't even got up and running yet. Just the credible threat alone was enough to do this, right? And again, every bit of information that I deliver to you is coming directly from the Federal Reserve itself. I'm using their words against them. I hope people realize this. Nobody else is giving you this information. I have not yet found anybody out there on the internet who is delivering this stuff like I am, right? And I don't mean to brag it up. I just wish more people would be doing it. I have all the files here that I could constantly be sharing with you guys, and I do. They're in the links of all the descriptions, and there is no other strategy that is being conducted right now by the Federal Reserve outside of this one, regardless of what anybody else says. And I know this because I have been absolutely accurate on calling out what it is that the Federal Reserve has been doing this entire time, because they've been telling us. They straight up tell us, we are going to keep interest rates elevated for an extended period of time, right? They kept interest rates extra low, extra long for an extended period of time to make up for the fact that they failed to achieve the 2% target. Now they're going to make up for that. They got a whole strategy that was written back in 2020, 42-page document describing exactly how they were planning on doing this. And part of that is a PSYOPs operation that says, hey, if we deliver an interest rate cut with a particular information, it'll either have an inflation expectation or a disinflationary expectation to it, but the cut can be the same. Just how do you deliver the information will have the outcome. All right, guys. Man, I've really gone off on this one. 24 minutes into this. And then I'm going to go back here and we're going to read a couple of comments and we'll call it quits. All right. Still probably cheaper to get gold from ground than churning lead into gold. Ron Paul to audit the Fed. The best part to me was the site got so many orders it shut down. My son and I are planning on some prospecting while in Nevada and Arizona next week. Hey, right on. Yeah, lead should be precious metal, run out 50 years. Have fun, Hyder. Yeah, that sounds like a good time. Glad people got his comedy and didn't lamb blast him. There are a bunch of cool old mines in Nevada. Hiders. Some are way out in the middle of nowhere. Also, you can turn lead into gold with some alchemy. All right, yeah, I've got a quad, but not a side by side. Higher for longer, yeah. I like checking out Google Earth a lot. I found all kinds of cool stuff in the desert nobody knows is there. Usually you actually go have spots. You guys are just having a fun time. Okay, please explain a bit about the Cantillon effect. You haven't touched on that in a while. Well, I mean, I don't know. What's the question on it? To me, like, the more I think about the Cantillon effect individually as just myself, like I don't even think about it I do think about it in the grand scheme of the macroeconomics part of things, but I think about it just as an individual too, because really the Cantillon effect is the same regardless if you are a business, an individual, a nation, it doesn't matter, right? It all kind of goes down the same way. In fact, even today we were talking about how like housing is so expensive, you know? And I had to explain to the gentleman that because he was like, man, something should be done. I'm like, there's nothing that can be done. I said, the problem is that we have people with 9 to 5 jobs, and then now you have people who are also remote working so that they have their 9 to 5 jobs and they're doing a side hustle of some sort, or they actually are working a whole other job. But the fact is that there is so many ways of making money now that beyond your 9 to 5 job, you have to compete against those people. Right? And that's very difficult. So if you have a limited amount of resources out there that are more available to people who are earning a higher wage or figuring out ways to get extra money, whatever the extra money is, money beyond the money you already have, right? But you start finding ways of this starting to come into the economy. Now you got people who are working a regular standard job that normally should have been enough to compete against everybody else out there, cannot compete against everybody else because everybody else is now going out there trying to figure out how to get extra money. And now you have to compete against the extra money. This is like the individual Cantillon effect. Your industriousness that used to be good has basically now got to compete against somebody else who's being far more industrious than you are. Even though your industriousness used to be competitive, it's no longer. Why? Because we have a higher standard of living to it. Now, of course, we may not think that as an individual that says, well, no, I'm still paying rent on a regular apartment, having a regular house. My standard of living hasn't risen. No, but everybody around you has, and you got to compete against them. Right? So just because your standard of living hasn't risen doesn't mean that you're not competing against other people whose standard of living has risen, and now you got to compete against that, right? So this is the problem that most people face. You have to have ever increasing amounts of new money coming in. And that's very difficult to have without a separation between the rich and the poor, because the more new money that comes in, the more difficult it becomes for the average person to now compete, because the new money is now being circulated within a smaller amount of resources like rental properties or houses or something like that. So now you got more and more competing against it. There's nothing you can do. The only thing you can do is become more industrious. That's it, right? Figure out how to become a capitalist or property owner. And this is what's awesome about nowadays is that, there was a time that the average person would have a very difficult time becoming a capitalist or property owner. Now, it wasn't like so difficult that they couldn't do it. It was just difficult in the sense that they had to be very disciplined, right? You had to, if you were going to work at the lumberyard and work the lumberyard kind of thing, you had to be very careful on how much money you were spending on your luxurious items out there, and be very disciplined on your savings and building up that account so that you could put the down payment on the house. This was something that was possible back in the day. Well, now the possibilities of saving up enough to buy, a $500,000 house is almost impossible for an average person to do. Like, you can't even get there, right? So this is, again, like a different situation in that we are now facing when it comes to being like in this economy. Like, you can't operate in that fashion. However, becoming a capitalist property owner is hella easy for most people when you can do it with Cash App. Like, you can literally do it $10 at a time. You can get into real estate investment trusts and ETF, stocks, home builders, whatever. You can expose yourself to all these different ways of becoming a capitalist and property owner, and you can literally do it just a piece at a time, and there's nothing that can stop you from doing it. right? Except for your own, lack of ambition for it. But literally, there's nothing out there that doesn't stop you from getting into that position. You do that your entire life, and you're going to do quite well. Now, if you don't, you're going to compete against people who are. That's the problem. If you don't do it, you're going to compete against people who are. You may not want to do it that way. That's fine. You don't have to want it. But being egotistical about the whole manner and saying, hey, it needs to go down in a particular way, means that you're probably going to end up failing. Like, I would love for my 9-to-5 job to be enough. Like, that's it. That's all I would have to do. That would be great. And it would be wonderful if an administration could come in and create that sort of economy for me to deal with. That would be wonderful. Thank you. I don't expect it, so I'm not going to plan for that, and I'm not going to deal with anything like, in that sorts that says, hey, man, you should think this way. I'm not going to. Like, it ain't going to happen, right? What is going to happen is I'm going to have to figure out ever-increasing amounts of ways of bringing in new money because the standard of living is going to get that much more expensive going into the future, period. There's nothing you can do about that. Right? So understand again that there is going to be a separation between the rich and the poor anytime that new money pours into the system. Every time somebody says government should do something, that's new money pouring into the system. Like, when government doesn't do something, that's money coming out of the system. And then again, pain and misery follows from that. So there is no direction in which that we can go where you either don't have pain and misery or you don't have more separation between the rich and the poor. There's only those two directions. And as much as like we want to have a different option, there's not. There's just not. Like, I mean, yeah, I would love for there to be a different option too. There isn't one. The only other option you have is to figure it out for yourself so that you know that there's nobody coming, nobody's going to save the day, and that you have to work extra hard, extra long for an extended period of time to make up for the fact that we no longer have an economy that's based off of production and savings. What else can we do? All right. Okay, I got like just a few more minutes. What's rich, what's poor? Right, you know what Cantillon describes wealth as? Food, conveniences, and pleasures of life. That's it. Food, conveniences, pleasures of life. If you have access to food, you're wealthy. If you got conveniences, you're wealthy. If you're enjoying pleasures, you're wealthy. It doesn't matter how much money you have. If you have access to food, conveniences, and pleasures of life, you are wealthy. Period. That's all there is to it. Like, it doesn't matter how much money you have. Like, that is, like, to me, that doesn't mean anything. People say, how much money you got? And I'm like, what is there, like, is there a number out there that makes you good and one that makes you bad? Like, what difference does it make how much money you have? Do you have access to food, conveniences, and pleasures of life? If you have those three things, you're rich. That's it. That's all there is to it. It's wealth. Right? Rich is a state of mind. It's an opinion that somebody else has. Rich doesn't exist. Poor doesn't exist. Right? It's all about the position in which that you are now feeling, and that's somebody else's opinion of it. Right? I mean, that's all there is. Somebody says, hey man, that dude's poor over there. How do you know? Well, is that the way he feels about it? That's the way you feel about it. That's your own personal belief, not his. I mean, he very well could feel he's poor too, but that's like, that's not up to you to decide. That's for him to decide. True, Wayne. Corporations doesn't necessarily mean partner up. Just work together for a common goal. Yeah, absolutely. All right, they're saying that deflation is coming is true. It's all about how you receive the information that results in an inflation or disinflation or whatever. Again, I don't know how many times I've said it. I say it over and over again. All right? Over and over again. It's not about the interest rate move anymore. Right? That is not the important part. The communication about it is. I think this proves it. The makeup strategy and the statements that were said right there about how it is that they could deliver an interest rate adjustment has the profound impact on whether or not it's going to have an inflationary or non-inflationary expectation from it. Like literally the same move, different delivery. So think about that. How is it that the people are receiving this information? If the people are receiving the information in a way that says, oh man, they're weakening the economy, it's a weak economy that's coming, that's going to have a lowering of inflation expectation. If they receive the interest rate cut that says, oh man, this is doing it for, whatever, how do they decide it's supportive purposes or something like that? Just like like almost like a benign systematic reasoning behind it, but not because of weakening economy, then that'll have an inflation expectation behind it. It's just as simple as that. You can look at the interest rate cut and say, how is this going to impact the economy? And say, I really don't know, because they aren't delivering it with any kind of reason. However, if you listen to the reason that people think from it, that will be the impact. Most of the time, the Federal Reserve will deliver the rate cut with a message. We are doing this for this particular reason, right? And with that will either be the inflation, or the higher or lower inflation expectation will be with the message, not from the cut itself. It's hard to explain this stuff. It's a psyops. This is the mind game psyops in a massive fashion. This is global psyops game. And it's obvious to me when you just when you look at some of the statements that are coming from these documents that come directly from the Federal Reserve itself, right? This isn't even something that you can make up when they have a report that they deliver directly to Congress, right? The full economic policy report delivered February 7th of 2025. Like straight up right there within their own statements of that, they say that we are not going for a 2% target, but going for 2%, or the appropriate monetary policy aims to achieve inflation moderately above 2%. They told Congress they were going to do that 5 years ago. They've been telling Congress every single day since then that that's what they are doing, that they are going for a 2% inflation rate over the long term. Everybody heard target, right? It's because that's the psyops that they're playing. If they didn't have people believing that they were going for a 2% target, none of this would work. None of it would work. That's why I'm saying people are like, man, audit the Fed, sue the Fed, do all this to the Fed. No, you don't have to do all that stuff. You just have to understand the Federal Reserve strategy from the inside. Not from the mainstream media, not from all these screwed up economists who don't understand what the Federal Reserve is truly doing. You understand it like this, and they would no longer be able to operate the way that they are doing today. They would just simply not be able to function any further, and they would fail. That would end the Fed. But as long as you don't see it this way, as long as we want to audit the Fed, as long as we want to sue the Fed, they will always be in power. That stuff isn't going to work. They're too powerful, too big, too rich, too many lawyers, got too many people in the pocket. But if you can understand their strategy so that it doesn't work anymore, that will end the Fed. Straight up. Like nobody else is trying to end the Fed like I am. I am the number one guy out here on the internet who is truly trying to end the Federal Reserve, because if people understood this, it wouldn't work anymore. They would end. It would end. Straight up, All right, I don't even care about wood, information, education, tariffs, and inflation. Just here to comment to help little dude out. Okay, little dude out, thanks. I don't even care about wood, information, education. You're just saying it over and over again. All right. Can you explain the purpose of the Fed's standing repo facility? Okay, I only got a few more minutes left, but yes, I will. Because a lot of people are very concerned about the repo facility coming to an end, but they don't realize that in September of 2019, that repo facility wasn't even being used. Right? September of 2019, the Federal Reserve was operating in what they refer to as a limited reserve system. Right now, it's operating in what they refer to as an abundant reserve system, which is the point of having a repo facility to begin with. Now, here's the thing. We have to understand that the Federal Reserve used to operate in a way that became very abusive, in the sense that the Fed had an ability to loan money to the banks. The banks were then borrowing that money and speculating in the stock market, and it was creating some real havoc within the economy. The Fed realized that. This was through the discount window. They said, okay, listen, we can no longer give you money through this discount window because you guys are borrowing it to speculate in the markets. And so anybody who's like, you can only use it in case you absolutely have to. Go find funding someplace else. And so any of these banks who went to the discount window were like looked at as like, hey man, you're in a bad place, right? You can only use this in like emergency kind of situations if you're like in trouble, essentially. Now you can go to the discount window at the Federal Reserve. Other than that, you have to get funding other ways. Well, this is kind of like the idea behind the discount window all the way up until even recent times, right? This is what a lot of these banks view the discount window as. So again, the Federal Reserve, this was like their main way of injecting money to the banking system, was through this particular discount window that now is no longer something that they can use because it has a stigma attached to it, okay? So we're just going to set that a little bit of information out to the side for just a second, just so you understand it. Now, in September of 2019, there was something interesting taking place. There was a lot of government spending that was happening at the time. Now, this government spending had the big banks like the JP Morgans, Goldman Sachs. These are the primary dealers. Well, the primary dealers are essentially forced, they're not forced, but they're forced to go to auction and buy these treasuries, right? Because the primary dealers are the ones who buy the treasuries, and then everybody else basically buys them from the primary dealers. So the primary dealers were up there buying a bunch of these treasuries because the government was doing a lot of spending at the time. They had these treasuries sitting on their balance sheet, right? Now, again, the way the banking system operates is that treasuries are very much in line with like reserves. Like you can hold them in like kind of cash because they're somewhat close to cash. Treasuries can be sold very quickly, so they're very liquid, and they can be considered cash in a lot of ways. But when it's time to actually have cash, because when contracts come due, they're due in cash, and so cash is like the lubrication for the system. And I know that's kind of a funny word to use, but that's really the reality of the situation, is cash is the lubrication that makes the system work. Treasuries can sit there and hold a place similar to cash, but then when it's time for cash, they don't work, right? So now here's the situation that we were facing in September of 2019, is that there was this huge corporate tax payment that was made. So all these corporations took a bunch of cash away from these big banks, the primary dealers, and they sent it to the Federal Reserve, right? Now, again, it wasn't like they were giving it to the Fed. It went to an account at the Federal Reserve called the Treasury General Account. So when taxes are paid, it moves the money to the Treasury General Account. The point being is that it was no longer in the big banks, but sitting over at this account at the Treasury or at the Federal Reserve for the Treasury, right? The Treasury General Account. Now the big banks didn't have enough cash in the system. They had loads of reserves, right? They had plenty of treasuries sitting there, but they didn't have cash to operate the next day. The overnight lending rate was going up to 10%. So now to understand the overnight lending rate is when the big banks, at the end of the day, some of them have excess reserves, some of them are in need of reserves. Because of the limited reserve system, the ones who had excess reserves would lend them to the ones who were in need of reserves. This overnight lending rate was the effective fund rate. So when the Federal Reserve was trying to establish a particular interest rate within the banking system, the Fed funds rate, it was this overnight lending rate that they were trying to manipulate. By buying and selling treasuries off these big banks, they were able to adjust the level of reserves that were sitting in these big banks that would then put the overnight lending rate in line with what it is that the Federal Reserve was targeting. So if they needed to raise the interest rates, they would start pulling a bunch of these reserves off the system. That would demand a higher return on the overnight lending rate, and therefore they could adjust the Fed funds rate. All right, so does that kind of make sense? I mean, I know this is complicated, but you get asked, right? Okay, so now the limited reserve system had a limited amount of reserves within the big banking systems. The Fed would buy and sell reserves off these big banks to adjust the Fed funds rate on the overnight lending between the big banks. On September, that overnight lending rate shot up to 10% because of that huge tax payment that had been made, pulled a bunch of cash out of the system. The next day was going to go operating. The big banks were like, hell, man, we can't operate. If we got an overnight lending rate of 10%, the financial market's going to freeze up, right? We got all of a sudden, all these like short-term loans are going to go like right through the roof as far as the interest rates that they have to be paid on them. So the Fed says, nah, don't panic, right? What we're going to do is we're going to open up the repo facility, which is an emergency pressure relief for situations very much just like this. They say, all those reserves that you have in treasuries, give us those. We're going to give you cash. We'll flip this around the next day, and we'll just do this all the time. So you'll have plenty of cash within the system to operate, so that the overnight lending rate is in that 10%, but back down to the target range of, well, it was probably around 2% or whatever it was at the time. I think they were lowering it a little less than that. But that was the point of it. We're like, hey, we're going to open up the repo facility, take those treasuries, hand you a bunch of cash. Now you have cash to operate, and we'll do this. And this was referred to as non-QE QE. Right? So now people are getting pretty scared because this repo facility, they see the money is getting gone, and they're thinking, oh my God, the repo facility is going to come to an end because we're running out of liquidity. But this is the way that the Federal Reserve had operated prior to 2019, between September of 2019. Now, they had operated with the repo facility during the great financial crisis, and that thing had, been used before. But this is typical of the Federal Reserve to have a limited reserve system. Once the repo facility has been depleted, the Fed can then switch into the limited reserve system. And again, the overnight lending rate amongst the big banks can now be the effective fund rate. Right now, the effective fund rate is established at the repo facility. So whatever the repo facility is giving for an interest rate, that's the effective fund rate. Now, there is another place that they could go with the excess liquidity. It's called the account on excess reserves, but the interest rate on that is not nearly as good as the repo facility, right? So now this is the way that they are able to channel the Fed funds rate. The effective fund rate is at the repo facility and the interest on excess reserves. Once that has been depleted, it can go over to remove the abundant reserve system, right, which would then have the money pouring into the repo facility, right? Then they could switch from an abundant reserve system to a limited reserve system. And at that point, the big bank's overnight lending rate would be the effective fund rate as opposed to the repo facility. And because they know that they need to inject money some way into the system, the discount window is being forced upon the banks, meaning like they have to have an account there and they have to use it a couple of times a year. And the reason why they're doing that is that if a bank is in trouble and they go to the discount window to get money, nobody will notice. Nobody will know, right? They're taking that stigma away from the discount window. All right, does all that make sense? I got to go. That was a wonderful live stream. I hope everybody kind of understands and gets where it is that the credible threat theory plays into a lot of this information. Each and every one of us takes this information in differently. You think about this, how many people lose their mind? Like I had a guy earlier today asking for a quote on some pole barn metal, and it was quite a bit. I mean, it was like I want to say it was probably like, a $1,500 order, which isn't huge. I mean, don't get me wrong, $15,000 would be a huge order, right? Or a big order. But it's, it's big for an individual, an individual person who's going to be spending some money on building themselves a shop or a barn or something. And they hear there's going to be a 25% price on, or tariff on steel, right? And all of a sudden they're like, oh man, I got to run out there and get my steel before it goes up in price, right? Well, think about the inflation expectation that was built off of this. Nothing's happened. Absolutely nothing has happened. But yet here he is talking to me about it. I need to hurry up and do it. Now, I don't, right? Because I'm an ethical, honest businessman. But I could take that expectation that he had and then mark my price up, right? Which creates the inflation in itself. The expectation leads to an actual inflation. And again, like I don't do that because I'm got to be competitive, because there's going to be the guy down the road he's going to take the quote down to, and then I got to compete against him. So I got to stay within reason of it. But you can see right there where the room for an elevated inflation expectation from the propagandized news that hasn't delivered any kind of reality to the situation has now impacted this the decisions that people are making. See how this works? All right. Again, it's all about how you receive this information. Like I look at it, like people are like, oh man, 25% tariff on lumber. And I'm like, okay, you really care? I mean, they just did like a 14% tariff on lumber. Nobody noticed. Nobody even nobody cared. Like nobody took any consideration 6 months ago with the 14% tariff on lumber. Right. But now there's a credible threat of a 25% one. It's all over the place. Man, lumber prices are going to go up. There's certain, all this other stuff. And I'm like, there was an actual tariff that actually hit lumber. Nobody cared about, didn't do anything to the prices as far as that goes. And now the threat of one coming in the future now impacts the prices. See how this works? Right? It's obvious once you see it. Like once you look back and you just take it in for the consideration of what it is. Look at it honestly, objectively, right? Without the bias. And you can see it too. It's like, man, why doesn't anybody else see it? All right, uneducated economist. You guys let me know.